The Bank of Canada turned heads this month when, for the first time, it included climate change as a top risk factor for this country's economy and financial system. It's significant for several reasons. With us now to explain why, on the line from Vancouver, British Columbia, Céline Bak. She is president of Analytica Advisors and a senior associate with the International Institute for Sustainable Development. And Céline, we welcome you back to the program. How's things out there on the left coast?
It's perfect. Sunny and gorgeous.
Oh, isn't it always? Okay. Yeah. Well, the Bank of Canada made this announcement, which turned a lot of heads, surprised a lot of people, indicating that they now see climate change as a significant risk factor to the banking system of the country. How surprised were you at that announcement?
Well, it was pre-announced, I guess, on March 27th, when the Bank of Canada announced that it was going to join a network of its international peers, the Network for Greening the Financial System, which is made up of central banks and supervisory authorities from around the world. And so when they said that a few weeks ago, we thought, okay, this is perhaps going to be a priority for the bank moving forward. And the annual financial systems review is really the sort of marquee publication for the bank and is watched and read by many. And it was obviously a nice opportunity to highlight the bank's change in its policy.
Well, these are supposed to be notoriously conservative people who, staff these organizations. And I wonder, were you taken aback when you found an institution as, supposedly stodgy as the Bank of Canada, now including climate change?
Well, the bank had, I guess, gone on the record about climate change 2.5 years ago or so, saying that carbon pricing was really going to be essential to make sure that climate risks were sufficiently well addressed within the economy overall. I think it was very much a surprise then when they decided that their policy was going to be expanded beyond making a formal, endorsement of carbon pricing. It means that the bank is going to build capacity to try and understand, how climate change in a couple of different ways affects the economy. One is the impact of climate change on the economy, so the impact of weather and acute and chronic events on everything from agriculture to the flooding in many people's homes, to the impact of the economy on climate change, which is the connection between the kind of investment that's being made in the energy system and what impact that has on rising temperatures and on the weather events that we're all experiencing.
Just before we go any further, maybe it's appropriate at this point to hear from the two senior-most officials in the bank itself, the Governor of the Bank of Canada and the Senior Deputy Governor, who had this to say at their news conference about this subject. Sheldon, roll it if you would.
For us, climate change is, it's of interest to central banks because of central bank mandates and how climate change can affect economic performance on the one hand and how it can affect financial stability on the other hand. And so that's the narrow focus that we have on it. And regulations and stuff, that's somebody else's province.
Stephen Poloz and Carolyn Wilkin in that shot there. Okay, who's going to regulate companies and banks to make a kind of risk assessment through a climate change lens?
Well, the capital markets in Canada are regulated by a few different actors. If you're a public company and you've listed your stock on one of the 3 or 4 stock markets in Canada, it's the securities exchange regulator of the province where your stock is traded. In British Columbia, there's a BC Securities Exchange Commission. There's one in Alberta, in Ontario, and in Quebec, l'Autorité des marchés financiers. So for companies, it's the stock markets and the regulators of those stock markets. As far as the banks go, we have in Canada the responsibility for regulation of the banking system and of pension funds and insurance companies is separate from the Bank of Canada. In the case of the Bank of England, it's actually some of those responsibilities are within the mandate of the Bank of England. And so it's the Office of the Superintendent of Financial Institutions who's responsible for regulating the banking industry. And it does so as part of a global collective of these types of institutions, which altogether make decisions about how to ensure that the banking system is safe and that it continues to serve the economy in a way which is productive and responsible.
Well, we've heard from the insurance industry, of course, that is almost mortified about how their ability to make a profit has changed over the last several years because of the significantly higher number of payouts they're having to make, they would say, because of climate change related incidents. How about banks? How would climate change affect the way banks do what they do?
Well, in some ways that are very similar and in some ways that are very different. So the similar ways would have to do, for example, with the risks to their customers who have mortgages, whose homes are potentially at risk of flooding, as an example. And to have your home flooded is a terrible event, but it's also a very expensive thing. And it can cost $40,000 to repair a basement that's been flooded. And we've seen this recently with terrible flooding in a number of parts of Canada. Not all of us have $40,000 in the bank waiting to just in case a flood comes, and this would potentially affect our abilities as mortgage holders and as homeowners to pay back our mortgage. So that's certainly a potential risk where increasing numbers of bank customers who have mortgages may find themselves with a very serious problem where they can't afford to pay both the repair on their home caused by climate change as well as their mortgage. There are sort of other types of risks which may have to do with global commodity markets, which is something that the bank is also hinting at in terms of the risks that it's seeing in the financial system, and that has to do with the lending that occurs to companies. There are many companies in Canada that have for many years worked hard to extract oil and gas from the ground and to do it in a way which is responsible and safe for the workers who are doing that. But as the price of oil declines because demand declines on a global basis, it may be that those companies, just like us as citizens having trouble paying off mortgages and repairing our basements, those companies may have a hard time repaying their loans for their businesses when the price of the commodity that those loans are pegged to is declining. And that's an example of how capital markets are very connected, and obviously the banking sector in Canada is subject to those conditions.
Ours is not the only central bank that has weighed in on this. In fact, there was an op-ed piece not too long ago from the governor of the Bank of England, who's a Canadian, Mark Carney, and the governor of the Bank of France, and the chair of the Central Banks Network for Greening the Financial System, and they all had this to say. We recognize that the challenges we face are unprecedented, urgent, and analytically difficult. The stakes are undoubtedly high, but the commitment of all actors in the financial system to act on these recommendations will help avoid a climate-driven Minsky moment, the term we use to refer to a sudden collapse in asset prices. Okay, that Minsky moment reference, can you see a scenario where climate change could take us down that kind of a path?
Well, one would hope not, and that's part of the job of the Bank of Canada. But I think that's exactly what they're trying to signal by saying that they're going to pay attention to this risk. And one can imagine a far-fetched scenario, but these scenarios are being driven by, for example, the reinsurance industry, the people who buy up all of the risks of insurance companies, who have said, for example, that one scenario that they have run through is a scenario where there's $1 trillion worth of climate-related damage. In 2017, we were at $350 billion. So imagine that being 3 times greater. And in 2017, it was half of the damage, about $180 billion, was insured, and the other half was not insured. And imagine if we had 3 times that, and let's say only a quarter of it was insured, and therefore, many companies were actually pushed into bankruptcy. It could be in that kind of a scenario that those who are trading global energy commodities, be that oil or gas, that they all of a sudden say, hey, we thought that the price of the global price for oil was going to be, such a level. And when we've seen, the extent of the damage which is being caused by climate change, we're not sure that policymakers are going to, for example, keep carbon prices as they are, or going to keep regulation as it is, or that they're going to do it at the pace that they're currently doing it at. And so all of a sudden they may say, okay, there's going to be a big change. And that might cause the fossil fuel reserves that are currently being estimated to have a certain value, that might cause those reserve values to be cut by the capital markets, who are, those who currently, assess the value of companies and assess also the value of those reserves.
Well, Céline, let's do an analogy from a decade ago when we went into the Great Recession, and clearly far too many companies didn't make good, sound financial decisions, which resulted in, they showed appalling judgment, and it resulted in an international financial meltdown, the likes of which we're only recently starting to come out of. Okay, the comparison is, do you think the financial services sector this time will have good enough judgment to take the precautionary steps and assess risk properly as it relates to climate change, or are they going to need regulations in place imposed by government to make that happen?
Well, I think there's some steps that need to be taken by all parties, regardless of whether there's regulation to be applied sooner rather than later. And the frameworks for those steps have been established already with extensive consultations and broad discussions, so that companies, including banks, would have to disclose to their shareholders, which is the pension funds that are investing money that we've saved, that they would have to disclose two things: how is climate change impacting the company, and how is the company impacting climate change? And so those two things are what are referred to as the physical risks of climate change and the transition risks of climate change. They're technical words, but basically it's two sides of the same coin. And to the extent that companies step up, be they banks or corporations, step up to say, okay, here's our plan, well, that will make it possible for shareholders, pension funds and others, to know what those companies plan and what their assumptions are about climate change. And where they see that the assumptions are not in line with the way they think the world will evolve, then they'll invest, they'll take their money and put it somewhere else. To the extent that we don't have that transparency, then there are very serious risks of having a repeat of what we had in the global financial crisis. At the same time, we need to be able to decrease the sort of friction that exists in terms of other information. And that other information includes, for example, the scenarios that are published by the International Energy Agency and others that really are the drivers of how corporations allocate capital. So at the moment, we have scenarios published by the International Energy Agency, and by the way, they're in Vancouver this week to talk about just this subject, that are almost aligned with the goals of 1.5 degrees of warming, but not quite. And so if we can get that kind of information and make it available to the banks and make it available to companies so that they can then turn around and say, okay, well, our strategy to deal, for our business with these constraints on carbon and these physical impacts of climate change is the following. We're going to invest in electricity infrastructure. We're going to become really, really capable at renewable energy generation. We're going to perhaps open new lines of business that really drive energy efficiency in the building sector. Whatever it is that they decide to do as companies. But without those two things, we absolutely have the possibility of a repeat of the scenario that we had with the global financial crisis.
Yikes. I was hoping, Céline, you'd have something more encouraging or optimistic to say about that, but no, eh?
Well, I think we've got a lot more to do in terms of stimulating investment in low-carbon electricity. Again, most recent reports from the International Energy Agency suggest that it needs to double, if not more than that. And so I think we can certainly see that there's lots of opportunity. There's, as you know, no end of innovation available. But without markets and without the signals to suggest that those markets need to form very, very quickly, and you know, if we don't step to it quickly, then yeah, we may find ourselves with more risk than frankly we should have.
Well, let's finish up on this then. Do you see any inherent conflict between the financial services sector of this country and, say, you know, the oil and gas sector in this country as it relates to the issue we're talking about right now?
Well, I think the oil and gas sector in this country is a sector that is extraordinarily capable at innovating and at dealing with very complex projects. And if it's given a signal by the banking industry that you know, there are really important opportunities to expand in areas that are low carbon, whether that's renewable energy or other, you know, other roles in the economy, I think that the interests can be aligned. And I'm hoping that I hear about that this week here in Vancouver at the Clean Energy Ministerial. So we'll see.
One final follow-up here. If you're watching this and you're in a pension fund, which is probably the vast, vast majority of people watching this right now, any advice out there?
Yes, absolutely. You know, you should ask the people who are responsible for your pension fund how they're engaging with companies, to ask them what is the impact of climate change on the company and what is the impact of the company on climate change. You know, pension funds are going to be wanting to hear from us more and more, and so we should be ready as savers to ask those questions.
Some good advice from Céline Bak, head of Analytica Advisors and a senior official with the International Institute for Sustainable Development. As always, Céline, great to have you on TVO. Thanks so much.
Thanks, Steve.
The Agenda with Steve Paikin is brought to you by the Chartered Professional Accountants of Ontario, helping businesses stay on the right side of change with strategic thinking, insightful decisions, and business leadership. Are you on the right side of change? Ask an Ontario CPA.